Hello, welcome back. This is the second video in the four-part series on funds. And in this video, we're going to be talking about exchange-traded funds, or ETFs, and I'm going to give you an introduction to them. So I'm going to start off by talking about what an ETF is, and then how it works. So, what is an ETF? An ETF allows you to track the performance of an index. And the next question you might have is what is an index? And an index is a group of 200 or more, generally, securities, securities being bonds or shares. And indexes are created by financial institutions, and they show the return of investing in a country or industry or theme. So what would have happened in the past if you'd invested in some large group of companies, either through bonds or through stocks. So some examples, and giving you an idea of the range, it can be an index that tracks what would have happened if you invested in the largest, 2,000 companies in the world, or, and this is over time or throughout history, or at least since this index has been going, or what would have happened if you'd invested in African government bonds, and then it might be a smaller amount of bonds out there compared to all the stocks in that first index. So this is to give you some examples of well-known indexes. Some of them might ring a bell. The S&P 500 being an index that tracks the 500 largest stocks in the US. The Dow Jones, which tracks large also stocks in the US. The Euro Stoxx 50 invests in the 50, an index that shows you if you'd invested in the 50 largest stocks in Europe at any given time. Of course, like all these, what is the 50 largest changes from day to day. Then the FTSE 100, the 100 largest stocks in the UK, the ASX, the Australian largest companies, and the MSCI World, which came up in the mutual fund example. It's an index showing just the largest stocks around the world. I think it was about 1,600 in that index, 1,600 different companies. So taking it back to an ETF replicates that index, any given index, by automatically buying or selling, as appropriate, all the securities in it to make sure that it has the exact weighting of all the companies by size in that index. So what it really does is it allows you to own a share of one of these indexes. Imagine if you wanted to buy the 500 largest stocks in the US, it would take an enormous amount of work just to do the admin to buy them, but then also you have to constantly be tracking them to make sure that you have more of a certain one as it grows larger and less of a certain other one as it grows smaller, or eventually leaves the index because it becomes too small. So this allows you to own a share of that without having to do any of that work. And you can buy shares in an ETF, this fund that does that for you, anytime through the stock exchange. That's why it's called an exchange-traded fund. It's a very useful thing. And there are more than 5,000 of them worldwide. And they're pretty easy to put into practice, because all you need is to have a computer to create the algorithms to be automatically buying and selling them. So these ETFs are created by fund managers, a bit like with mutual funds, and often fund managers do both. And unlike mutual funds which are active, these are passively managed, because once a fund manager chooses the index, they have no more control over what to invest in. It depends on what's in the index, and that's all determined about usually size and the weighting in the portfolio. So because of this, because it's quite little work, then fees are very low, usually less than 0.5% compared to the 1 to 2% we saw with mutual funds. So it's a really great way for a non-professional investor to gain exposure to a large part of the economy as they choose. And they're usually more than 500 bonds or stocks in an ETF. So to give you an example of how they actually work, I've put together a model index. I call it Joseph's very simple index, because there's only 10 constituents, and as I said, usually there's several hundred. So I've just chosen 10 fairly large, well-known companies, and the value of them is just simply the market cap, which is what the stock market is valuing them at. So Microsoft, as I say here, and these will change obviously constantly. I put in at 800 billion. These are enormous numbers, so that they're fairly accurate. And altogether, the companies of this index are altogether worth $3 trillion. And you can see their weighting is based on how much their value, each company's value, is of the total amount of the value of all these companies combined. So Microsoft's 800 billion is 27% of the value of all of these companies, these 10 companies together. So it's a large part of it. So then, let's say a fund manager comes along and they say, well, we think this is a good index. People would like to buy this, gain exposure to those companies. So we're going to create an ETF to track it. So they go out, they ask investors, would you be interested? And investors say they are, such as yourself potentially. And this fund raises $500 million to do that. So from day one, they then have to replicate using, as I said, an algorithm. They're not trading all day long. The computers can do it for them. They say they need to track at any given time what the size of these companies are within this index. That's all they have to do. They need to make sure that the weighting is always right compared to how much money is in this fund. And there's $500 million to invest in this fund, so they need to weight that appropriately. So you can see, to make sure that 27% of the fund is in Microsoft, they have to invest 133.3 billion of their dollars into that straight away. So that's day one of the ETF, to replicate that, that index. And then you as an investor can buy shares in this ETF, which gives you exposure to all of these companies. So let's say, as I said, they've raised $500 million, this fund. They can choose how many shares they want to issue. And a bit like with stocks, it's usually just for the sake of having a nice value per share, a share price that they want. So say they choose to give 10 million shares to people for that 500 million. That means each share is worth $50, 500 million divided by 10 million. So if you want to buy now a share in this ETF, which gives you, as I say, exposure to all of these stocks by their weighting, you have to pay $50 for it. And then, yeah, you have this share in the fund. So what happens in the future? Well, this depends on the index. That's going to determine the performance of this fund. So let's say in the index, the companies as a whole go up by 6%. But each company performs somewhat differently. So Microsoft goes up by 5%, and something like Google goes up by 10%, you can see here. And others like Levi's go up by 10% too. So even though Microsoft has gone up, it's gone up by slightly less than some of the others. So its weighting is no longer 27%. Instead, its weighting, it's the value of it divided by the total value of all these companies is now 26%. And you can see Google, for instance, has gone up to 14% weighting because its value has gone up by more than Microsoft. So the point is, the ETF will be automatically, through these algorithms, through the computers, mimicking this weighting. So it would have to have sold some shares in Microsoft and bought some in Google to make sure that it's appropriately weighted to match this index. And this is how it would look. And from the value of the share price, you can see that would have gone up by 6% because all of the assets it holds on average have gone up by 6%. So the shares of this ETF are now worth $53.08. So if you bought it at 50, you then can sell it at 53 because the combined value of all of its companies that it owns have gone up. So that's an overview of ETFs, an introduction to them, and in the next video we're going to look at two particular examples of actual ETFs you can invest in. Thanks very much for watching, and I'll see you in the next video.